Hello and thanks for tuning in. This is part 2 of the video on consolidation. Consolidation. Across the markets, consolidation generally takes place as an attempt to establish, strengthen or confirm a solid base of support. It is most commonly seen as a place for the market to rest, recover and attempt to absorb any supply that is drawn out in response to a sharp or sustained rise in price. Consolidation is also seen following a serious decline in price, where the market attempts to recover and establish a new level of support. Now we'll just scroll lower. This is what we looked at last time. This is where we're up to. Consolidation in a market where price has fallen sharply or is trending lower. When a market breaks down or moves considerably lower, and especially when the losses have taken place over a relatively short period of time, increased buying support may begin to be drawn out in an attempt to stabilise the market. This buying support may occur as an effort to defend against supply, or because at these much lower prices, some in the market may begin to see value emerging and a possible opportunity for future growth from these lower price levels. The new buying support in the market may cause price to move sideways or even rise somewhat in response. And on this chart, we can see price has been steadily declining. There was an attempt to support the market here, and price did pop out the top, but then it moved into a sideways trading range. It didn't really accelerate higher. This period where buying support begins to emerge is a secondary form of consolidation. It is effectively an attempt to stabilise or support the market and allow it to recover from the stress and difficulties associated with a sharp or ongoing reduction in price. The period of consolidation can develop organically or naturally in the market, or it may be encouraged to occur deliberately by professionals in the market. With considerable and sustained selling pressure in the recent background of the market, a period of consolidation of this type may often fail. The fresh new buying support will often encounter increased and ongoing selling pressure from the market. This may eventually overwhelm the buyers, causing them to dump their new positions, which in turn may re-establish the previous downtrend, sometimes violently. That happens because they dump all at once, and that really creates a widespread down bar in response. And that's how you can see when it happened. This supply can emerge in support of existing short positions, or because some holders, which did not sell initially as price broke down, effectively are offered a second opportunity to sell out of their positions as price attempts to stabilise. It is this ongoing and sustained selling pressure which can eventually overwhelm buyers and cause the consolidation to fail. And here's a little chart showing price moving lower. If I remember rightly, this was Aussie dollar currency futures, and price moved into a sideways trading range in an attempt to stabilise and support the market. This is a consolidation of some form, and price avoided breaking down here, attempted to hold on, but this bar here, price broke down and the market continued lower. A relatively large and recent fall in price, followed by a brief and shallow period of consolidation, forms what classical or traditional technical analysis may identify as an unconfirmed bear flag. Confirmation of a bear flag comes when the attempt to support the market fails and price re-establishes the downtrend, moving clearly below the sideways period of consolidation. And we can see this chart here, which has a nice little bear flag there. This is the flagpole. Here's the flag. This is just a period of consolidation in support of the market after it broke down. There's the breakdown line, there's the breakdown bar. Here was the period of consolidation. And you can see how the different forms of technical analysis all do work together. The market then attempted to consolidate a second time. It was a little more successful this time, but price wasn't able to hold on. I'll bring the breakdown line across. You can see it wasn't able to move back above that level. And then price, here's a little gap there, which is the hollow part of the bar. Price gap below the recent lows, and price began moving lower. There was another attempt to support the market here, but that looks like it also failed. Conversely, in the downtrending market, where there is an attempt to consolidate, there may be an extended period of sideways trading in consolidation, or the market may even produce a sharp rise in price, a reversal of sorts. This suggests that the selling pressure in the market may be weakening and that the buyers may have an increased chance at success. A period of consolidation like this may only develop into a counter-trend rally and still could eventually fail. However, a sustained and ongoing period of sideways consolidation can sometimes develop into a true accumulation or reaccumulation zone, creating a solid base of support from which a fresh new uptrend may emerge in the future. Finally, any positive reaction to a period of consolidation in response to a large fall in price remains vulnerable to failure. Until price is able to move sustainably back above the highs of the initial recent fall in price, it will remain vulnerable to failure. The vulnerability reduces to some degree the higher price rises in response, but is not completely extinguished until price moves sustainably above the previous highs. Until this occurs, the price action may just form a counter-trend rally, which may eventually fail. You can see on this chart, here's the breakdown line, here's the breakdown, the attempt to consolidate, and what appears to be a new breakout from the consolidation zone, but that never really even challenges the breakdown line, and price immediately reverses. And here, if we draw in the lows of the range, here's the fresh new breakdown bar. There's only a very muted response, and price continues lower. A period of consolidation can offer a deeper insight into the underlying market sentiment. Apart from a period of rest, recovery, and removing supply from the market, the period of consolidation can also offer the chart reader some insight into the broader market sentiment. The depth and duration of the consolidation can offer certain clues as to the underlying strength or relative weakness of the market, allowing a judgment to be formed, reinforced, or confirmed. A brief and shallow period of consolidation suggests the market is relatively strong and holds a more positive sentiment when compared to a period of consolidation which is forced to dip more deeply lower and one which takes much longer to complete, which is usually due to ongoing selling pressure that becomes more difficult and time-consuming to absorb or buy. As a general rule of thumb, the 50% level of the total recent rise in price can be used as a guide to estimate the relative strength or weakness of the market sentiment, regardless of whether this is a single bar that rises in price or an overall trending market made up of many bars. A period of consolidation that occurs in the top half of the total recent rise in price is generally considered to be stronger than one which needs to dip well into the bottom half of the range to complete the period of consolidation. The higher within the range the consolidation is completed, the more positive and stronger the broader market sentiment can be considered to be. And here we have a Bitcoin chart. This is Bitcoin futures, and there had been some previous buying support in the background here. This was the final dip lower, which at the time, if I remember correctly, we called a little accumulation zone, and price accelerated out with real vigor. And although it appears that supply has been drawn out of the top, I think you'll find that this was more like a buy the offer bar, and price was allowed to drift lower on relatively low volume, pretty much under its own weight, you might say. And in response, the consolidation zone was relatively high in the range, and then price accelerated higher again. There was an attempt to consolidate right up at the highs of this range, but some increased supply did get drawn out, and the market then pulled back and consolidated around the 50% level, and price then trended higher without really accelerating higher like it had done previously. Finally, just be a little careful with this principle of using depth and duration of a consolidation to judge the underlying market sentiment. As always, the chart analyst needs to stay flexible in their analysis and look for any reasons why the market may pull back more deeply than expected, as there are sometimes exceptions. An example of an exception is where price gaps up and accelerates higher, often in reaction to some positive economic or market news or in response to a favourable company announcement. An inside gap in particular may be formed, which has a higher probability of being closed, even if this action is only due to some form of confirmation bias across the market or as a self-fulfilling prophecy. That doesn't matter. What does matter is that the market does come back and closes the gap for whatever reason. This may see the market come right back down to close the gap prior to resuming the push higher with some intent. And I did have some trouble finding an example of this, but I did find this chart, which hasn't yet shown me the response, but there is a gap here that hadn't been filled. This was a company announcement where price pushed higher, and it seemed unlikely at the time that price would come back and fill the gap, but it did so in 3 days. A period of consolidation can reset the volume profile during an uptrend or downtrend. In a trending market, the expected volume profile associated with the trend are for volumes to be expanding or increasing when price is moving in harmony with the trend, and are contracting or reducing when price is moving against the general trend. So in an uptrend, you're expecting to see volume gently increasing on the up bars and contracting on the down bars. And we can see that in this chart here. If we look at this bar, which is some sort of test for supply, and volume had reduced here. Prior to that, the market had been undergoing a bit of an accumulation here, some buying, price roared out. You can see volume increased as price pushed higher. And then as price came back, volumes reduced. And then as price accelerated higher again, volumes increased. It was a test for supply, and that was low volume. And then as price accelerated out, volumes increased. This is what you want to see in a market that's trending higher, expanding volumes on up bars and contracting volume on down bars. In a market which is trending higher, for instance, the expected volume response is for volumes to be steadily increasing on the up bars within a trend, and for volumes to be reducing on down bars within the trend. This shows there is buying support in the market when prices are moving higher, and that there is reduced supply or a lack of selling pressure when prices move lower. The inverse is also true for a downtrending market, with increasing volume on down bars and reducing volume on up bars, showing support for the downtrend along with reduced demand for higher prices. If this situation is allowed to play out for an extended period of time without an effective reset of the volume profile, the expectation of increasing volumes would soon become unreasonably high and excessive, with volumes expected to be well above average. From time to time, the volume profile needs to be reset back to normal levels, where the expanding volumes can again resume. Often a single bar test for supply achieves this reset, as a successful test for supply will often have below average volume, and the expanding volume can again resume from the reduced levels. A brief and shallow period of consolidation can also allow a market to reset the volume profile back to more normal levels, with the sideways trading eventually displaying much lower volumes. The market may then be better placed to begin the next expansion of volumes in harmony with the previous trend. And you can see that on this chart. When the market tested for supply here, volume reduced. If the increasing volumes continued on this trajectory, we would soon have massive volumes that were just unsustainable and really quite silly. So these periods of test for supply or a period of consolidation can reduce the volume back to more reasonable levels where price can then accelerate again with expanding volumes on the up bars. Now that's really the end of my talk, but I did have a couple of spare charts which I thought I would just share with you, showing some consolidation. There had been a downtrend in place here. There was a short period of consolidation and absorption going on here, which sort of formed an accumulation of in some respects, and then price accelerated higher. Now you will notice here that the up bars, which are represented by the blue volume bars here, are increasing and are much higher than all these down bars, which are the pink or red bars. So you can actually see there that volume is expanding as price moves higher on the up bars and contracting on the down bars. So there's a little selling pressure in the market. Now here, when some supply did get drawn out, price moved back into a consolidation for a short period before pushing out again, testing for supply, accelerating higher again, testing for supply. You can see here that volume was starting to be drawn out. This was a little bit of a climactic action up here of some sort. And then price is attempting to consolidate in response here, but I think a new downtrend actually started after that. This is the last chart. You can see there was a little bit of accumulation here. This is a good example of a little mini accumulation zone here. Price accelerates out, tests for supply, accelerates higher, draws out supply, moves into consolidation sideways, pushes out again. Now this, although it is probably some form of consolidation, this was such a mini accumulation here, and if I remember rightly, I can't remember what chart it was, but price had been moving down for a long time. This looks to me a lot like another accumulation here. It's probably taking some form of consolidation as well, but that W shape often represents accumulation, and then price pushed out of the top, moved into consolidation to test for supply and make sure selling pressure wasn't going to be overwhelming, and then started to push higher in response. Okay, that's my lot. This was probably the biggest project I've ever done. You made it this far and watched both videos. Thank you very much. Hopefully it was worthwhile. Thank you. See ya.